Inflation is one of the most powerful forces in the global economy, yet many investors underestimate how deeply it can reshape their financial decisions. When prices begin rising across the economy, everything from groceries to housing becomes more expensive. But inflation doesn't just affect daily spending. It quietly changes how money moves through financial markets and can dramatically influence the performance of different types of investments. To understand why inflation matters so much, it's important to recognize what it actually does to money. Inflation slowly reduces the purchasing power of cash. In simple terms, the same amount of money buys fewer goods and services over time. For investors, this creates a serious challenge. If your investments are not growing faster than inflation, your real wealth is actually shrinking, even if your portfolio appears to be increasing in value. One of the first places inflation shows its impact is in interest rates. When inflation rises, central banks often respond by raising interest rates to slow down spending and stabilize prices. In the United States, the Federal Reserve plays a key role in managing inflation through these monetary policy decisions. Higher interest rates can ripple across the entire financial system, affecting everything from mortgages and business loans to stock valuations. Stock markets often react strongly to inflation expectations. When borrowing costs rise, companies may face higher expenses and reduced profit margins. This can make investors more cautious about paying high valuations for certain stocks. Growth companies, particularly in the technology sector, can be especially sensitive because much of their value is based on future earnings rather than current profits. At the same time, inflation does not affect all sectors equally. Some industries actually benefit from rising prices. Energy companies, commodity producers, and businesses with strong pricing power can sometimes perform better during inflationary periods. When companies are able to pass higher costs on to customers, their revenues may rise along with inflation. Another major investment category affected by inflation is bonds. Bonds typically provide fixed interest payments over time. When inflation rises, those fixed payments lose purchasing power, making bonds less attractive to investors. As a result, bond prices often fall when inflation expectations increase. This dynamic is one reason why inflation can create volatility in traditional investment portfolios that rely heavily on bonds. Real estate is another asset class closely tied to inflation. Property values and rental income often increase when prices rise across the economy. This can make real estate an attractive hedge against inflation in certain circumstances. However, rising interest rates can also increase borrowing costs for property buyers, which may slow down housing demand and limit price growth in some markets. Commodities are frequently discussed as a natural hedge against inflation. Assets such as oil, metals, and agricultural products are directly connected to the physical economy, and their prices often rise during inflationary periods. When the cost of producing goods increases, commodity prices may rise as well, making them a popular investment during times of economic uncertainty. Gold has historically played a special role during inflation. For centuries, investors have viewed gold as a store of value when currencies lose purchasing power. During periods of high inflation or economic instability, many investors move money into gold as a defensive strategy. While gold does not generate income like stocks or bonds, its perceived stability often attracts attention during uncertain economic environments. Currency markets can also shift dramatically during inflationary periods. Countries experiencing higher inflation may see their currencies weaken relative to others. This can influence international investments and global trade patterns. Investors who hold assets denominated in foreign currencies may experience gains or losses depending on how exchange rates move during inflation cycles. Another important factor to consider is consumer behavior. When inflation rises, people often change how they spend money. Households may cut back on discretionary purchases such as entertainment, travel, or luxury goods. Companies that depend heavily on consumer spending may see slower growth during inflationary periods, which can influence stock performance in those industries. Inflation also impacts long-term financial planning. Retirement savings, for example, must account for rising living costs over time. If inflation remains elevated for several years, retirees may need significantly more savings than originally expected. This is why many financial planners emphasize the importance of maintaining investments that have the potential to outpace inflation over long periods. Technology and innovation can also play a surprising role in inflation trends. Advances in automation, artificial intelligence, and digital services may reduce production costs in certain industries. Over time, technological progress can help counterbalance inflation by making goods and services more efficient to produce. Government policy is another critical factor shaping inflation and investments. Fiscal spending, tax policies, and economic stimulus programs can all influence inflation levels. When governments inject large amounts of money into the economy, demand may rise faster than supply, contributing to upward pressure on prices. For investors, the key lesson is that inflation changes the investment landscape. Strategies that worked during low inflation environments may not perform the same way when prices begin rising more rapidly. Diversification becomes even more important, as different asset classes respond to inflation in different ways. Ultimately, inflation is not just an economic statistic reported in financial news. It is a powerful force that reshapes investment returns, market behavior, and long-term financial outcomes. By understanding how inflation affects different markets, investors can make more informed decisions and better prepare for a changing economic environment.